Patricia retired at 63 from a school district in Phoenix, Arizona. She had taught fourth grade for 29 years. She had a traditional IRA worth $420,000 that she had built through payroll deductions her entire career. When she sat down with her financial advisor the month she retired, the advisor ran a simple calculation and told her that if she claimed Social Security at 67, her full retirement age, she would receive $2,100 per month. If she waited until 70, she would receive $2,640 per month. The difference was $540 per month. The advisor said the break-even point was around age 82 or 83. If Patricia expected to live past 83, waiting made sense. Patricia was healthy. Her mother had lived to 91. She decided to wait. What the advisor did not show her was the second half of the calculation, the part that shows what happens to the $420,000 IRA while she is waiting for Social Security to start. The part that shows what the IRA distribution she takes in those 7 years do to her tax bracket. The part that shows how much of her Social Security becomes taxable once both the IRA distributions and the Social Security income arrive at the same time. The advisor showed her a simple break-even. He did not show her the integrated math. And the difference between those two calculations, when you run them side by side over a 25-year retirement, is not a few $1,000s. For Patricia, it was over $100,000 in cumulative taxes she did not need to pay. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. My name is Nancy. Every week, I break down the tax rules, the financial traps, and the strategies that help retirees understand the things that often go unexplained. If that sounds useful to you, subscribe and turn on notifications so you never miss a video. Today, I am going to walk through the Social Security decision framework that accounts for a traditional IRA, not just the simple break-even that most retirement articles use. The framework that connects when you claim Social Security to what happens to your IRA, your tax bracket, your required minimum distributions, and your Medicare premiums. I am also going to explain why the gap years between retirement and age 70 are a financially significant period in retirement and why many retirees do not use them strategically. Let me start with the numbers the way they are typically presented. If your full retirement age is 67, which applies to anyone born in 1960 or later, you have three main claiming windows. You can claim as early as age 62 and receive a permanently reduced benefit, approximately 30% less than your full retirement age amount. You can claim at your full retirement age of 67 and receive 100% of your earned benefit. Or you can delay past 67 up to age 70 and receive an 8% increase per year in delayed retirement credits, which equals a total 24% increase over your full retirement age amount. Before going further, I want to address one concern that comes up regularly. Many retirees who stop working before their full retirement age but still need income consider claiming Social Security early in order to reduce IRA withdrawals. This seems reasonable. Why draw from savings if Social Security income is available? The answer involves the earnings test. If you claim Social Security before your full retirement age of 67 and you are still working, the SSA reduces your benefit by $1 for every $2 you earn above $22,320 in 2026. In the year you reach full retirement age, the reduction is $1 for every $3 above $59,520. After you reach full retirement age, there is no earnings test at all. For retirees who have fully stopped working, the earnings test is generally not a concern. But for retirees doing consulting, part-time work, or side income, claiming early while earning above the threshold creates a benefit reduction that is applied monthly and can be difficult to track. The 8% per year delayed credit is not an estimate. It is a guaranteed permanent increase confirmed by the Social Security Administration. It does not fluctuate with the market. It does not depend on investment returns. It is a fixed government credit that permanently increases your base benefit, and every future cost of living adjustment applies to the higher base. That means the gap between claiming at 67 and claiming at 70 grows every year you are alive because the COLA increases apply to a larger number. In 2026, the average Social Security benefit for a retired worker is approximately $2,000 per month. For a retiree with a benefit at full retirement age of $1,200 per month, claiming at 70 instead of 67 means approximately $2,220 per month. The difference is $528 per month, or approximately $636 per year in additional income, permanently indexed to inflation and guaranteed by the federal government. The simple break-even calculation takes that annual difference and divides it by the cumulative payments you gave up during the 3 years you waited. It concludes that if you live past approximately 82 or 83, waiting was the better choice. That calculation is not wrong, it is incomplete. And in retirement planning, an incomplete calculation is often where money gets lost. Here is what the simple break-even does not account for. When you retire before 70 and you have a traditional IRA, there is a gap period, a period where your employer paycheck has stopped, Social Security has not yet started, or is not yet maximized, and you are living on savings. For most retirees, that gap period lasts somewhere between 3 and 10 years, depending on when they retire and when they claim. During those gap years, your income is at or near its lowest point in your entire retirement. You have no W-2 income. Social Security has not started. Your IRA and any pension are the primary income sources available. For many retirees, this is the lowest income period of their adult lives. That low income gap period has a name in financial planning. It is called the Roth conversion window, and it is one of the most valuable tax planning opportunities available to a retiree with a significant traditional IRA. Here is how it works. Every dollar you convert from a traditional IRA to a Roth IRA during those gap years is taxed at your current income tax rate, which during the low income gap period is often 10 or 12% for many retirees. Every dollar you do not convert during the gap years will eventually be forced out as a required minimum distribution starting at age 73, at whatever tax rate applies at that time. And that future rate will be higher for most retirees because by age 73, Social Security income, RMD income, and possibly other income all arrive simultaneously. Let me make this concrete with Patricia's numbers. Patricia retires at 63. She delays Social Security to 70. During those 7 years, she needs approximately $35,000 per year to cover living expenses and draws that from her IRA. Option 1, Patricia draws $35,000 per year from her IRA to cover living expenses. She takes exactly what she needs and leaves the rest invested. By age 70, her IRA balance is approximately $360,000. Social Security starts at the higher delayed amount. She begins taking required minimum distributions at age 73. Her combined income at 73 includes Social Security plus RMD plus any other income. Her combined income exceeds $34,000, the threshold above which up to 85% of Social Security becomes federally taxable. Her RMDs grow every year. Her tax liability grows every year. Option 2, Patricia draws $35,000 per year from her IRA for living expenses, but she also converts an additional $20,000 per year from her traditional IRA to a Roth IRA during those 7 gap years. Her total annual draw is $55,000. She pays income tax on $55,000 at a relatively low rate because she has no other income during the gap years. After the standard deduction for a single filer in 2026 of $15,000, plus the additional senior deduction of $2,000 for those who qualify, her taxable income in the conversion years is manageable. By age 70, she has converted approximately $140,000 out of her traditional IRA into a Roth IRA at low tax rates. Her traditional IRA is now smaller. Her required minimum distributions starting at age 73 are meaningfully lower. Her combined income is lower. Less of her Social Security is taxable. Her Medicare premiums may be lower. And her Roth IRA grows tax-free for the rest of her life with no required minimum distributions ever. The difference between option 1 and option 2 is not minor across a 25-year retirement. The cumulative tax savings from strategic conversions in the gap years, the reduction in forced RMD income, and the reduction in Social Security taxation can reach 6 figures for a retiree in Patricia's situation. If what I just described has you thinking about your own IRA balance and retirement timeline, subscribe and turn on the bell so you do not miss future videos on this topic. Now, let me walk through each of the four interconnected systems that make the Social Security decision more complex than a simple break even. The first system is the required minimum distribution interaction. When you delay Social Security and use the gap years to do Roth conversions, you reduce the traditional IRA balance that will be subject to required minimum distributions starting at age 73. A retiree who has $400,000 in a traditional IRA at age 73 and made no conversions will have a larger RMD than a retiree who converted $140,000 in the gap years. The larger forced distribution stacks on top of Social Security income. That stack pushes more Social Security into the taxable range and may push the retiree into a higher marginal bracket. The retiree who did the conversions arrives at age 73 with a smaller traditional IRA, a larger Roth IRA, a higher Social Security benefit from delaying to 70, and lower total forced taxable income because the Roth does not generate RMDs. The second system is Social Security taxability. The IRS calculates your combined income for Social Security taxation purposes as your adjusted gross income, plus any tax-exempt interest, plus 50% of your Social Security benefits. For single filers, once combined income exceeds $34,000, up to 85% of your Social Security benefit becomes federally taxable ordinary income. For married couples filing jointly, the threshold is $44,000. These thresholds have not been adjusted for inflation since 1993. They are frozen. Every year, inflation pushes more retirees above them. A retiree with a $2,700 monthly Social Security benefit, about $3,400 annually, who also takes a $25,000 required minimum distribution from their IRA, has combined income of approximately $73,600. That is well above the $34,000 threshold. Up to 85% of their Social Security, approximately $27,500, is now taxable ordinary income. A retiree who reduced their RMD through earlier Roth conversions and has a smaller forced distribution keeps combined income lower and may keep more of their Social Security benefit out of the taxable range. The third system is Medicare premiums. Medicare Part B and Part D premiums are determined using your modified adjusted gross income from 2 years prior. In 2026, the standard Medicare Part B premium is $185 per month. The first surcharge tier begins at $106,000 in modified adjusted gross income for single filers. Above that threshold, the premium increases. The surcharge applies for the full year. A retiree whose combined IRA distributions, Social Security income, and other income push their modified adjusted gross income above the ERMAA threshold pays meaningfully more per year in Medicare Part B premiums than a retiree who stays below it. Reducing the traditional IRA balance through gap year Roth conversions reduces the future RMD income that could push a retiree into IRMA territory. Let me put specific numbers on the RMD interaction so this is not abstract. Assume Patricia's traditional IRA is worth $420,000 at age 63 when she retires. She takes $35,000 per year for 7 years to cover living expenses while delaying Social Security. Assume 5% average annual growth on the remaining balance. In option 1, with no conversions, after 7 years of withdrawals and 5% annual growth, her IRA at age 70 is approximately $360,000. At age 73, after 3 more years of 5% growth, her balance is approximately $416,000. Her required minimum distribution at age 73 using the IRS Uniform Lifetime Table Factor of 26.5 is approximately $15,700. That $15,700 plus her Social Security of $32,736 plus 50% of Social Security pushes her combined income to approximately $64,800, well above the $34,000 threshold. Up to 85% of her Social Security is now taxable. In option 2, with annual conversions of $20,000 during the 7 gap years, she converts $140,000 total. Her traditional IRA at age 70 is approximately $143,000. At age 73, her traditional IRA is approximately $166,000. Her required minimum distribution at 73 is approximately $6,164, over $9,000 less per year than in option 1. That lower RMD combined with a lower combined income calculation may keep more of her Social Security out of the taxable range in some years. And the $140,000 in the Roth IRA generates zero required minimum distributions and zero taxable income, regardless of how much she takes from it. The tax savings in any single year may seem moderate. Over a 20 to 25-year retirement, the cumulative difference compounds into a number that is meaningfully six figures for a retiree in Patricia's situation. The fourth system is the survivor benefit for married retirees. The higher earner's Social Security benefit becomes the survivor benefit when one spouse dies. The surviving spouse keeps the higher of the two benefits permanently. A higher earner who claims at 70 instead of 67 locks in a 24% higher monthly benefit, not just for themselves, but as a permanent income floor for their surviving spouse for the rest of that spouse's life. The value of maximizing the higher earner's benefit is not only the higher monthly check during joint lifetimes. It is also the financial protection for the lower income surviving spouse who may live for decades on that single benefit. This dimension of the Social Security decision does not appear in the simple break-even calculation. The break-even treats Social Security as a single-person income source and treats the benefit as a fixed number. But the benefit is not fixed. Every year, the Social Security Administration adjusts benefits for inflation through the cost of living adjustment. In 2026, the COLA was 2.5%. That COLA applies to the base benefit you locked in when you claimed. A retiree who locked in a higher base by waiting to 70 receives the COLA on a larger number every single year. A retiree who locked in a smaller base by claiming at 62 receives the COLA on a smaller number every single year. The gap between early claiming and delayed claiming does not stay fixed. It widens every year inflation exists. Over a 20-year retirement with average inflation of 2 to 3% per year, the cumulative gap between a benefit claimed at 62 and a benefit claimed at 70 grows substantially beyond what the initial monthly difference suggests. For married couples, it is also the most important financial protection available to the lower earning spouse. One more point that is important to understand before the checklist. Roth IRA withdrawals do not count toward your combined income for Social Security taxation purposes. This is one of the most valuable and most frequently overlooked features of a Roth IRA in retirement. When you take money from a traditional IRA, it enters your adjusted gross income. That increases combined income. That potentially makes more of your Social Security taxable. When you take money from a Roth IRA, it does not enter adjusted gross income. It does not affect combined income. It does not change the percentage of your Social Security that is taxable. This means a retiree who has both a traditional IRA and a Roth IRA has flexibility that a retiree with only a traditional IRA does not have. In any year where combined income from the traditional IRA and Social Security would push into the 85% taxable range, the retiree with a Roth can substitute Roth withdrawals for traditional IRA withdrawals to keep combined income lower. The Roth provides income without the tax friction. This flexibility, using traditional IRA withdrawals in low-income years and Roth withdrawals in high-income years, is called tax bucket diversification. And it is the practical reason why building Roth assets during the low-income gap years has value regardless of any specific tax rate prediction. A retiree with all assets in traditional accounts has no flexibility. Every dollar of income comes with the full Social Security taxation interaction. A retiree with a meaningful Roth balance has an income source that does not trigger that interaction. Here is your action checklist. First, log into SSA.gov and create or access your My Social Security account. Download your Social Security statement. You will see your projected monthly benefit at ages 62, 67, and 70. These are the numbers you need to run the integrated analysis. Second, calculate the gap years between your planned retirement date and age 70. If you plan to retire at 63, you have 7 gap years. If you plan to retire at 65, you have 5. Each of those years is a potential Roth conversion opportunity. Third, estimate your income during those gap years without Social Security. Take your projected IRA withdrawals plus any pension or other income, minus your standard deduction and any applicable senior deduction. The taxable income remaining is the space available for Roth conversions at your current bracket. A single filer in 2026 can have up to approximately $40,300 in taxable income and remain within the 12% federal bracket. Fourth, compare two scenarios projected forward to age 85. Scenario 1, claim Social Security at 67, make no Roth conversions, let the traditional IRA compound, and generate full RMDs starting at 73. Scenario 2, delay Social Security to 70, make annual Roth conversions during the gap years up to the top of your current bracket, and arrive at 73 with a smaller traditional IRA and a larger Roth. Project the cumulative federal taxes paid in each scenario. The difference is the real cost of the Social Security decision when the IRA is included. Fifth, if you are married, model the survivor benefit scenario. Take the higher earner's projected benefit at 70 and estimate what the surviving spouse's income would look like if one of you passes at ages 75, 80, and 85. The survivor keeps the higher of the two Social Security benefits. If the higher earner claimed early and locked in a permanently reduced benefit, the surviving spouse may live for 15 or 20 years on that reduced amount. The cost of early claiming for the higher earner is not only a personal calculation, it is also the income floor for the lower earning spouse after death. Sixth, be aware of the additional senior deduction available in 2026 through 2028 under recent tax legislation. Single filers age 65 and older may qualify for an additional deduction. Married couples who are both 65 and older may qualify for a larger combined deduction. This reduces taxable income during the gap years, which creates more room for Roth conversions before crossing into a higher bracket. Consult a tax professional for the specific amounts that apply to your situation, as these details are subject to change. Note that this analysis is most relevant for retirees with significant traditional IRA balances. If most of your retirement savings are already in a Roth IRA, or if you have no traditional IRA, the gap year conversion opportunity is smaller or may not apply, and the simple break-even is a closer approximation of the right framework. Let me address the most common objection to this strategy. Some people say they cannot afford to delay Social Security because their savings will not last. This is a legitimate concern for a specific group of retirees. Those who retire early with limited savings and genuinely cannot sustain themselves for 7 years without Social Security income. For that group, this approach may not apply. Claiming Social Security earlier can make sense when the alternative is genuine financial hardship. No tax strategy justifies running out of money. But if you have a traditional IRA with a meaningful balance, even $200,000, you have an asset that can fund several years of living expenses while you simultaneously do Roth conversions and wait for the higher Social Security benefit. The IRA is the bridge asset. It is what makes the strategy feasible. The retirees who benefit most from this integrated approach typically have between $200,000 and $750,000 in traditional IRA accounts, are in reasonably good health, have basic living expenses covered without Social Security, and have not yet started required minimum distributions. That describes a large portion of the 60 to 73-year-old retiree population. The second objection is that a financial advisor has already recommended claiming at 67 based on the break-even analysis. The break-even is a useful starting point, but it is a one-dimensional analysis of a four-dimensional problem. It does not model the IRA. It does not model the Roth conversion opportunity. It does not model the RMD interaction. It does not model Social Security taxability under different income scenarios. Asking your advisor to run an integrated analysis with all four systems modeled together is a reasonable request and a valuable exercise regardless of what the conclusion turns out to be. Patricia in Phoenix ran both scenarios 2 years after she retired. After a conversation with a tax professional who specialized in retirement income planning, she had already been taking only what she needed from the IRA for 2 years without doing any conversions. The professional showed her the integrated projection. She immediately began doing annual Roth conversions for the 5 remaining gap years before her Social Security started. She recovered most of the opportunity she had missed in the first 2 years. The math that nobody showed Patricia at retirement was not secret. It was available at IRS.gov under Publication 590 by E for the RMD rules, at SSA.gov under the Delayed Retirement Credit section for the Social Security rules, and at IRS.gov under Publication 915 for the Social Security taxability rules. All public, all free, all documented. The math that nobody showed Patricia at retirement was not complicated. It required connecting four systems: Social Security, the IRA, required minimum distributions, and Medicare, that many financial professionals treat as separate conversations. When you treat them as one connected decision, the Social Security timing question stops being a bet on how long you will live and starts being a tax planning question with a clear and calculable answer for most retirees with significant traditional IRA balances. You are watching Senior Tips USA. If this video walked you through the integrated calculation for the first time, consider sharing it with someone you know who is between age 60 and 70 and has a traditional IRA. Tell me in the comments what age you retired or when you plan to retire, and whether you have started thinking about Roth conversions during the gap years. I read every comment, and understanding where you are in your retirement helps me create videos that address the specific situations most relevant to you. Subscribe for more videos on retirement tax planning and Social Security strategy.